Next up is the pullback to a 10-week line. This is something very helpful to use. Many times you'll just be using this to pyramid into a position, but occasionally you'll have missed a stock, or maybe you've sold the stock, taking some gains, and you're looking for another entry point. This is really an ideal place to be buying some shares. Now, the concept behind the 10-week line is it's an area of support. Many of the institutions will notice as a stock is starting to get weak and it comes into that 10-week line, they're going to step in and start supporting the stock. If a stock breaks through a 10-week line in any large way, maybe 5-10%, at that point it almost always is either topping or it's just going to form another basing pattern. So many of the institutions, they don't want that stock to roll over or be dead money for a while, so they step up, they buy the shares, and many people just don't like to buy at new highs, so it's an ideal place for those people to be buying. So it's really a self-fulfilling prophecy. As the stock gets into that line, everyone's paying attention to it. They're seeing how it's going to act, and then it will bounce off of it, or sometimes it'll penetrate just a little bit below it. The key is really, where are you going to buy? All right, so how you buy off of a 10-week line really depends on how your makeup is, how your personality is. Do you like buying a stock at the very best price, as low as possible? If so, you're going to want to buy it as it's coming into your 10-week line, kind of on weakness. If you're built a little bit more like I am, where once I buy something, I want to see it go up right away. I want to know that my buy was right. Then you're going to have to wait, pay up a little bit, but you're going to be waiting for that strength to come in. Let's go over both ways to do it. Some people will just pick and choose depending on how the stock is acting. Sometimes you could even split the difference and do a little bit of both. Add some shares as it's getting weak, and then follow up as it's gaining some strength. So let's see how we're going to do that. Our first stock is going to be Akamai Technologies, AKAM. And let's look at this action after it broke out of this huge, very long cup with handle. Breaks out, and you can see one pullback, two pullbacks, third pullback, it kind of undercuts the line, then it runs up, and then eventually you can see what I was talking about. It broke through that 50-day enough where it just needed a base build, and it built a little cup with handle, came crashing back through the 50-day one more time, and then ran up. So technically, when you're looking at a weekly chart, it's a 10-week line. Many times you'll hear us at seminars or in books say a 50-day. It's basically the same thing. It's over a 10-week time frame. So let's study the first pullback. The first pullback to the 10-week line here actually happens on the week of the breakout. So if you had already established a position a little bit earlier, which is reasonable because you can see that it kind of formed an earlier handle in there. If you had a position as it was coming into that line, you could be adding to it there. Runs up for 3 weeks, pulls back in, actually twice this time. The first time it comes back, touches the line, then it's dead money for a week, and then really bounces off the line with some power. And then it's not really ready to have a huge move yet, so it just goes up for a little bit, comes back in, and that's where it undercuts the line. You can see on a weekly basis, after it crashed through the 10-week line, it closes right there with the 10-week line. That's ideal. If you go below the line intra-week, by Friday, you'd like to see it closing at the line or higher, showing a sign of strength, a sign of support. If it's closing weaker, typically, more times than not, you'll see it move lower, as it does a little bit later and during that base. On its way down to 27.14, you can see how that first time it bounces off that line, but the next close is below it, and it just needs to mark some time for a while. So you have a few weeks in there, and then eventually moves higher. So this is the stock on a weekly chart. Let's move over to a daily chart to see exactly where you would be buying these shares. All right, so looking at the Akamai daily, it looks quite different than the weekly, especially when you're focused in on the 10-week line. And you'll notice, depending on how the data kind of falls, sometimes it'll undercut on a weekly chart, but not on a daily, and vice versa. Sometimes it won't even touch on one of them, but it will on the other. This is just because the moving average is based on the closing values. And so on a daily chart, you're going to have a lot more values that it's using, 50 different values, versus a weekly where you're just using 10. So depending on where it closes for each week, you'll see kind of a bigger difference between the two. I will find myself looking at which one does a stock tend to get support on. I'll find myself looking at both, kind of seeing where the character is, where does it tend to get support if the two lines are different? Does it get more support on the daily than the weekly? So each stock will be a little bit different, and as you start buying off the 50-day, you'll get a sense of what to use. But I do like looking at the daily chart to look at my precise buy points, whereas the weekly is more the context of the uptrend. So looking at Akamai here, you can see as it's originally breaking out over the 1754, it's a really strong move up to 22.25. And when I'm looking at my positions, I always have in the back of my mind, this stock can come back into the 50-day at any point. And that's just one of the things you'll notice. The more charts you look at, you'll see stocks that look super strong, and then they just start getting weak just out of nowhere, and they'll pull back into the 10-week line, the 50-day, and that's really the make it or break it point. Does it get support or does it not? So it's a good little thing that you can do when you're looking at your account. You might want to calculate the difference between the value of your stocks, where they are now, versus if they came all the way into your 50-day, and that's the type of risk that you have in your account. It's a little trick that I use. You might want to try it out. So looking at this Akamai, so it comes up to 22.25, it starts backing away, and it comes down almost touching its 50-day, hits that 1902. So if you are going to be buying on weakness, you might start buying on that day that it actually hits the 1902 near the bottom of that day, thinking that it's probably going to go lower. In this case, it doesn't. I wouldn't be buying it at that point because I'd be wanting to wait for a little bit more strength. So let's see what ends up happening. I still wouldn't be buying the shares. Then it comes down one more time, and on that big day that reverses up where it hits a low of 1957, that's your ideal point to buy. It's moving higher versus its last week, and you have a big spread on there closing near the highs. You can see a pickup in volume. That's kind of perfect action. The only part that is not ideal is the fact that it doesn't touch that 50-day line. That would be a little bit better, but as I said earlier, sometimes they won't come all the way in there. Everyone's just seeing the same thing, and they're jumping in before it can actually touch that line. So again, with buying this stock, the first time it comes into the line, I would wait until that day where it hits 1957. I wouldn't be trying to guess the bottom here and buying it there at the low. I'd wait until it actually moves higher, goes above the highs of the prior week, and at that point, I'd be establishing my position with the expectation that it's going to move higher. Now, if you just wanted to buy as it was coming in, not having a sense of how much lower it could go, just as it gets within 1% or 2% of that line, you could just start buying shares knowing that it might be dead money for a week or two. So let's say we bought some shares there after the first bounce, and it runs up to a higher high. That's what you'd like to see. The fact that it is able to move higher than that 22.25, moves all the way up to 24.14, that's good action. Higher highs, and then you can see it's starting to establish higher lows as well. That's the general definition of an uptrend. You want to be trading stocks and holding stocks that are in a clear, well-defined uptrend. So it moves up to 24.14 and starts backing away. Now this time, if you were buying on weakness as it was coming in, a couple days before it hits that 20.49, you could start buying some shares. There would be nothing wrong with that if you prefer to buy on weakness. I would wait for some sort of strength. And the strength that you see here is this big shakeout below the line, goes all the way down to 20.49. I wouldn't be buying the shares there. But after it moves back up and near the end of the day, you can see it gets back above the line. At that point, you've got a big spread closing near the highs. The volume action is looking good. That's where I'd be buying some shares. Within a week, you get a big gap up. If you didn't have enough shares at that point, you might nibble on a few during that gap up all the way up to 27.59. So as it hits that 27.59, your uptrend is still intact. You've hit higher highs. The 27 is higher than the 24, and the 24 is higher than the 22, and so on. So the stock is acting well. So it moves up, and now that 50-day is kind of catching up to it. It's not really bouncing off the line. It's starting to catch up to it. So if you wanted to do a last tiny little buy off the line, notice it hits that 24.96. You're not buying it there. You're waiting until that blue day where it closes above the prior highs, and you could be buying a little bit. That's really stretching it. The other buys are more ideal, but if you're buying off of a 50-day, sometimes you can add a little bit of shares there. So let's step back. We originally started buying it as it was breaking out at 17.5. Let's say we bought 1,000 shares there. On the first and the second pullback, maybe you're buying 200 or 300 shares. On a gap up, maybe you're buying another 100 shares. And on this last one, maybe you're buying 100 shares. Keeping in mind you're trying to buy fewer and fewer shares the higher it gets, being aware of that cost basis. So that was Akamai Technologies back in the 2006 timeframe. All right, next is Ross Stores, or ROST. This broke out of a little odd-shaped double bottom. The reason why I call it odd is because that second bottom really undercut that first bottom by quite a bit. It's not typical. It's not a pretty-looking double bottom, but that's one way that you would interpret this chart. Someone else might look at it as a little tiny flat area that never broke out and then went down and formed a cup with handle. There's not really a right or wrong way to look at it. So with this double bottom, you can see that it actually gives us a shakeout +3. So before it goes through the middle of the W, it gives you a buy point that you may have established a position, and it doesn't really get anywhere and comes back in and it tests you, and it just bounces right off of that 10-week line and also the 40-week line. It's something we don't talk about a lot, but we have on all of our charts. That's that black line there. If a stock goes through there and can't find support, you're typically out of the stock in most cases. That is really a slow moving average, and it's something that we use as a reference point of really how far away from that line are you. Many times we'll look at it, is the stock just getting carried away and it's more than 100% from its 200-day. On those rare occasions in the midst of an uptrend where it does come in and touch that 40-week line, you really want to see some supporting action and a real bounce off of there. And that's what we get here. You have a nice little shakeout. Maybe you sold some shares. And if you did, you can be buying them back as it starts moving higher. There's nothing wrong with that. And you can see it moves up for a few weeks in a row. Let's see, 1, 2, 3, 4, 5, 6 weeks in a row. Very nice action. Not a ton of price progress, but it's healthy that each week is just inching up. Then you pull down just gently into the 10-week line. And you'll notice how different stocks have different characters. This one, you can see that it's kind of slow and pokey, and that's nice to have in your account. You don't want to have an account full of the Akamas of the world that we were just looking at that are very volatile, or some of the other ones that we've been going over during this home study that have a really nice upside, but on the way there, there's tons of volatility. It's nice to have some slower names like this in your portfolio. So as it's coming into that 10-week line, it just touches it, closes right at that 10-week line for your second red week, and then it starts bouncing off of there, and that's where you could be adding some shares. And if you missed the original buy, maybe you didn't use the 3 weeks tight and you didn't buy it as it was going out of that double bottom, this is someplace where you can initiate a position. You can see after that buy, it doesn't really give you another opportunity to buy it all the way up until it hits that $70 price range. So let's look at the daily chart to see exactly where we would be establishing this position as it's bouncing off the line. All right, as we're looking at the Ross Stores daily chart, you can see that the chart looks more volatile on a daily than a weekly. That's why we always start off on those weeklies to get the context of what is going on, what is the character of the stock, and then we look at the dailies to get our precise buy points. So let's assume we've established our position with that shakeout +3. Now we're up on the stock, runs up to 45.34 and starts backing away. In your mind, you're thinking, where can I get more shares? Where's the most logical entry point? And it starts pulling back into the 50-day. As it's getting closer and closer down to that 50-day, you can start buying some shares, maybe within 1% here. So as it's in the $42 range, you could start buying some shares. I typically don't like to buy that way. I'm waiting for that additional strength with the assumption that if I buy it exactly right, it'll go straight up. So on the day that it actually hits a low, going briefly below the 50-day and then closing back well above it with a decent spread, closing near the highs, you could be buying a few shares there. Probably not your full position that you're buying off the 50-day. The next day where you get more evidence of the strength with that gap up, you could be finishing your buys. So if you were planning on buying 300 shares off of the 50-day, maybe you buy 100 or 150 shares on that first day, and then you follow up buying the rest of the shares on that gap up. Don't feel like you always have to buy all your shares on the same day. You can always wait for a little bit more evidence to make sure that the stock is solid and it is going to move higher. So the stock just moves up in a very nice, predictable fashion from that point on. So that was Ross Stores just here recently. All right, next up is Mellanox, MLNX. This was a very volatile trader and not for the faint at heart. So some of the other stocks that we were looking at, like the Ross Stores that we just went over, that'd be nice to have in a portfolio with the Akamai to balance out the type of volatility that was going on. So starting off with the weekly chart, you can see it's been kind of a rocky road, but a nice uptrend. It hit bottom, ran up to 27, had a really sloppy base all the way down to 14, and then eventually works its way up into the $30 price range. If you'd been trading this stock, it probably would have been very, very frustrating because the moves were not very orderly. When I look at this chart, it gives me a sense of stay away, I'm very volatile, don't buy me. That's just what I see here. But you always want to pay attention. The character kind of changes, and you can see from the $28 price range all the way over to where we're picking this up with this little tiny cup without handle, it starts tightening up and acting quite a bit different than it did before. So if you're buying it off of that cup without handle that had a low of $30, it doesn't really move up too much, and it pulls back into the 10-week line. That's really not an ideal place where you're going to want to be buying the shares because you're not up on the position. If you missed it at the original breakout, that's someplace where you could be buying some shares. It's really, you could look at it as either a pullback into the pivot area or a pullback into the 10-week line. So if you're establishing a position there on that first pullback to the 10-week line, it runs up for about 4 weeks and it backs off in a very constructive fashion, closing above mid-range, giving you a sense of supporting action the day before that really big up week. So let's move over to the daily chart to see where exactly we would be buying these shares. So on the daily chart, you can see that action as it was moving up the right side of that little cup, you had a very nice gap up on some good volume. And then it was holding in there with a nice little uptrend up to 38.98, and it comes right in to find support at the 50-day. So the sense that I get with this daily chart is a lot better than that weekly. Very constructive action after that gap up. It's almost as if that gap up has changed the character of the stock. So if you were establishing your original position off of this first pullback, I wouldn't buy it on that first day that it comes down to the 35.18. I'd wait for 4 or 5 days, and that big up day where it closes above the highs of the prior 3 days, closing near the top of the range, that's where you could start establishing a position. Now, it's not the most ideal place to be buying a stock, but if you've missed it originally, you could be buying it there. Or if you were worn out of the stock because it really wasn't going anywhere, you could be buying back your shares that day or the following day. So that moves up a little bit, and you can see it pulling back in to the 10-week line or the 50-day on this chart. And it hits that 39.71. I wouldn't be buying shares there yet. Really looking at this, the assumption would be that it would probably come in a little bit more, but it doesn't come in more. And you have this tiny little gap up, and that's the day on this chart where I would be buying some shares because it tried to pull into the 50-day, now it's gapped up, and your expectation is that it's going to move higher. You're not expecting this huge gap up that happens, but if you'd bought it on either one of those days, you'd have a position on that huge gap up all the way up to 67.20. So that was Mellanox back in 2012.